Yesterday, the Canadian federal government tabled their 2024 budget, and some major changes were announced to the way that the capital gains system is taxed here in Canada. In this video, I'm going to quickly go through the changes that were made so you can determine for yourself whether you need to make any changes to your ongoing investment, retirement, and estate plans. Quick disclaimer here that this information is very, very new, and so this video is not intended to be investment or tax advice whatsoever. It's just an overview of the changes that were made, and then you can consult with the professionals in your life to see what changes are appropriate in your situation. But let's get into the details right now. So capital gains tax is the idea that you're going to pay tax on some of the growth that happens on investments that are non-registered. So this is typically on real estate. So if you have a vacation property or a rental property, or if you have non-registered investments like stocks, mutual funds, ETFs, things like that. This will not affect RSPs or TFSAs or any other registered plan. This is just on non-registered investments. So previously, capital gains, we paid taxes on 50% of the growth. But now the new system that's being proposed is a two-tiered system for individuals. On the first $250,000, that 50% or 1/2 inclusion rate is still applicable, but on any amounts over $250,000, the inclusion rate has jumped up to 2/3 or approximately 66.67%. Now there is another wrinkle here for corporations and trusts, and now all capital gains for corporations and trusts are going to be taxed at the 2/3 inclusion rate, and that is pretty significant. But in this video, I'm just going to be talking about the individual impact. So if you're curious about the corporate impact for someone who might be an incorporated professional, these aren't necessarily big corporations like Loblaws or TD Bank or something like that. Think of doctors, dentists, small business owners. These would all be incorporated professionals that might be affected by this. So if you're interested in that, leave me a comment below and I can maybe put together a video for that too. So let's go through an example here on how this might work in theory. So say for example, someone bought something for $200,000. This could have been a cabin or something like that. Maybe this was many years ago. And it was purchased for $200,000, and now the time has come to sell this property for whatever reason. In my hypothetical example here, the property is then sold for $550,000. So this would be a total gain of $350,000, okay? And so under the old rules, 50% of this would be included in that person's income and then taxable at their marginal rate. And so 50% of 350 is 175. So the 175 would then be included in their income along with all their other sources of income to come up with their total taxes payable. So it's tough to give an exact figure on how much this hypothetical person might actually pay, but that's how much would be included in their income in the old system. Now, going towards the new system, the first $250,000 has the 1/2 or 50% inclusion rate. So $125,000 of that first $250 is included in their income, but then there's still $100,000 of gain that has a 2/3 inclusion rate, and so that means that $66,666.67 is also included. So under the new rules, just shy of $192,000 would end up being taxable to this person in this hypothetical scenario. So a few notes to make here about some other situations that we should be very clear about. So like I mentioned before, this will not impact you if you have RSPs or RIFs, LIRAs, LIFs, TFSAs, pension plans, anything like that. This is only applicable to non-registered investments only. However, many people that you know, maybe your parents, grandparents, friends, whatever, probably do have non-registered investments, and so this could be applicable to them. Second thing to mention is that this change has been given some notice before it actually comes into force. This is pretty unusual for changes that happen in budgets. Typically, once the budget is announced, then everything is based on that date. However, we've been given a little bit of lead time here to make any changes under the old rules. So June 25th of 2024 is the proposed date for when these new rules are actually going to come into place. So I suspect that this deadline will lead many people who are going to make a large decision on, say, a rental property or vacation property, if they're going to sell it sometime this year. Those people are probably going to be selling it in the next few weeks here. So there is a scenario where many properties might come onto the market much sooner than anticipated. So because there's a deadline, that doesn't mean that you have to be selling things in advance of that deadline, but it is just another consideration based on the timing that you might want to do that, if especially you had a potential sale of property coming up sometime in the near future. Third thing I want to mention is that this might seem kind of like a tax the rich type of policy. In the budget, the government mentions that they're forecasting only 40,000 Canadians will have capital gains of $250,000 or more by 2025. The problem with this forecast is that those are people that will incur $250,000 of capital gains all at once, and doesn't account for the people who have $250,000 or more of gains that won't necessarily be realized all at once. So the way that this is probably going to come to a head are the people that are going to pass away with vacation properties, rental properties, non-registered stock mutual fund ETF portfolios that have unrealized gains. So the idea of realized gains means you actually sold it and now you have to pay the taxes. Whereas there's many people that have unrealized capital gains well over this amount. So this will impact much more than just the people that are churning out 250,000 plus of capital gains for income every year. This will affect everyday people that bought properties a long time ago or when prices were quite a bit lower relative to incomes. Non-registered investments were much more common before 2009, especially because the TFSA didn't exist yet. So many people will have non-registered portfolios alongside their RSPs and TFSAs, especially if they're over the age of 55, 65 and older. So this will become an estate planning consideration as well if someone has non-registered investments or additional properties over that $250,000 of gain. It might be worth talking to your financial planner, your accountant, and your lawyers to see if some other decisions over a shorter period of time might make sense for you. So this was just a quick look at the changes to the capital gains system here in Canada. Again, these are just proposals for now until the budget is actually given royal assent. I suspect that that's probably going to be the case. And so over the next few weeks, have a look at your situation, talk with your financial planner, talk with your accountant to see if this will impact you. And again, let me know in the comments if you'd like to see a video on the impacts for incorporated professionals. There's some significant changes there that need to be considered as well. If you're new to the channel, hi, I'm Evan. I'm a certified financial planner professional, and in my channel here, I try to help Canadians understand their investment situation better, their tax situation, retirement, and estate planning. So if any of those are interesting for you, I'd really appreciate it if you subscribed or shared this video with a friend who might find it valuable as well. Thanks so much for watching. We'll see you in another video.